On July 27, 2026, global headlines were dominated by a momentary reprieve. A pause in the conflict between the United States and Iran sent Brent crude futures falling 6.1%, while the Dow Jones opened over 600 points higher. This chart highlights a growing internal contradiction. While fuel prices retreated, top-tier semiconductor stocks like Nvidia and AMD experienced a sudden sell-off. The cooling of the energy market failed to stabilize the broader system. On that same day, Japanese Prime Minister Sanae Takaichi addressed the nation, not to celebrate the ceasefire, but to reassure the public that Japan had secured enough oil and naphtha-derived plastics to last through the spring. Domestically, the U.S. government quietly admitted in court filings that it had canceled over $7 billion in clean energy grants. The administration explicitly targeted projects in states that voted for the opposition in the 2024 election. These events suggest that the systems of a unified, peaceful global market are failing. Navigating the economy of 2026 requires understanding three specific rules of the new macroeconomic landscape. Rule 1 describes a shift in industrial planning. National budgets and production schedules are increasingly dominated by military expansion, treating defense as a central pillar of economic growth. Right now, India's shipyards are currently delivering a new warship every 6 weeks. By using 75% locally sourced content, they are building a massive fleet of 200 vessels while insulating their manufacturing from external supply shocks. In Russia, the war effort is being sustained through direct barter rather than open trade. Moscow is trading raw cash and military technology for North Korean ballistic missile launchers and 30,000 fresh troops. This aggressive global buildup highlights the limitations of the West. The U.S. unexpectedly paused its Middle East strikes, largely because its inventory of air defense weapons has reached a critical low. Defense manufacturing is integrating with the broader industrial base, transforming from a specialized sector into a primary engine for global production and trade. Rule 2 describes the transition from high-efficiency logistics to defensive resource hoarding. Developed nations are prioritizing survival over the low-cost, precise delivery models of the past. Prime Minister Takaichi's statement to the Japanese public emphasized that naphtha-derived plastic products would only be available through next spring. When Japan has only 8 months of visibility into essential supplies, it proves logistical fractures in the Middle East and Europe are making traditional trade routes unreliable. This uncertainty forces continuous overprocurement, creating a higher baseline for commodity prices even as industrial consumption slows. This hoarding model creates a persistent price floor for essential resources, favoring corporations that have secured localized and defensive supply lines. Rule 3 defines artificial intelligence as critical national infrastructure. Global superpowers now treat high-end computing as a strategic asset to be protected and weaponized. The U.S. market is grappling with the fragility of this asset class. Nvidia recently guaranteed $250 billion for a circular computing lease with OpenAI, raising fears that a halt in capital expenditure growth could trigger a broad financial contagion. China is responding with its own domestic tech surge. The memory chip maker CXMT saw its stock price rise over 400% during its IPO today, leaving the company with a market capitalization of $484 billion. This technology gap is driving a new trade war. The U.S. is threatening massive tariffs against the European Union in response to a $1 billion fine the EU levied against Google for violating digital regulations. The race for AI supremacy is dividing the global tech sector into isolated, highly defensive zones where trade is governed by security rather than profit. These global shifts are placing the U.S. Federal Reserve under immense pressure. Central banks are struggling to manage domestic interest rates while facing unmanageable inflation driven by overseas conflicts and the rising costs of resource hoarding. We are seeing an increase in weaponized fiscal policy. Political leaders are using executive power and federal grants to reward allies and punish opponents, turning national spending into a direct tool for domestic political control. This trend is visible globally. Indonesia's central bank chief resigned recently as the nation's currency depreciated, a direct result of massive increases in social spending that widened the budget deficit. These three rules demonstrate that the global economy is no longer acting as a single, efficient machine. In a world of severed supply lines and technical arms races, isolated resilience has become the most valuable economic asset.